This indicator is seriously powerful. It's built on a triple smooth exponential moving average structure, which helps it filter out a lot of the noise you normally see on a chart. Because of that smoothing, it can give you a clearer view of trend direction and momentum shifts, which makes it useful for both trend-following approaches and reversal-style setups. In this video, I'm going to break down exactly what the indicator shows, how to read its signals, and how to apply it inside a practical trading workflow. Stay until the end because the real edge comes from how you confirm the signals, not from taking every crossover you see. Alright, let's add the indicator. Go to Indicators, then search TXRI. Look for TX Histogram TRIX Histogram bias.You'll. Click it, and it will appear in a separate panel below your price chart. Now, what you're looking at is an oscillator. It moves above and below a center line, which is the zero level. You'll notice two main visual parts. First, the histogram bars. Second, a line that moves with the histogram and reacts to momentum changes. The core idea is that this oscillator is derived from a triple smooth EMA process. In plain words, you're taking an EMA, smoothing it again, then smoothing it one more time, and the indicator reflects the momentum behavior of that triple smooth value. That triple smoothing is why it tends to ignore a lot of small, messy price fluctuations and instead emphasizes more meaningful swings in trend momentum. Now let's interpret what you see on the screen. By default, TX is displayed as a histogram. If you ever want it as a single oscillator line instead, you can open the indicator settings and switch the display option so TX is shown as a line rather than bars. For this explanation, we'll stick with the histogram because it makes momentum changes easier to spot at a glance. Here's how the histogram works. When the histogram is below the zero line and it's red, that suggests bearish conditions and downward momentum. When the histogram is above the zero line and it's green, that suggests bullish conditions and upward momentum, but there's more detail than just red or green. Below the center line, you'll often see two intensities of red. When the red bars are extending further away from zero, downside momentum is strengthening. When the bars start shrinking toward zero and the red shade becomes lighter, it usually signals that bearish momentum is weakening. That weakening can happen for two common reasons. 1. A pullback inside a larger downtrend. 2. Early signs that a reversal could be building. Above the center line, you'll also see two intensities of green. When the green bars are expanding upward, it shows bullish momentum is increasing. When the green bars start shrinking towards zero and the tone darkens, it suggests bullish momentum is fading. And again, fading momentum up here can mean a pullback inside a larger uptrend, or possible weakness before a trend reversal. So think of it like this: position relative to zero tells you the trend bias. Changes in bar size and color intensity help you read momentum shifts happening inside that trend. Now you might ask, can I trade the moment the histogram crosses the zero line? Yes, a zero line crossover can act like an early alert. If the histogram moves from above zero to below zero and turns red, it can signal a potential transition into a downtrend. If it moves from below zero to above zero and turns green, it can signal a potential transition into an uptrend. But here's the problem: zero-line crossovers alone can be unreliable. A deep pullback can briefly push the oscillator across zero, then price snaps back and the new trend never actually develops. That's why you need confirmation before treating a crossover like a real reversal entry. Now, let's talk about the other key feature you'll see. There's an orange line in the indicator panel. This is the signal line, which is basically a moving average of the TRIX line used to help detect momentum shifts through crossovers. In the settings, you can enable crossover markers so the indicator highlights where TX crosses its signal line. These signal line crossovers can be used as momentum triggers. When the histogram crosses above the signal line, that's a bullish momentum signal. When the histogram crosses below the signal line, that's a bearish momentum signal. This becomes especially useful for trend following, because it gives you a way to participate during pullbacks instead of chasing the trend at the worst moment. Here's the rule set for trend following. If the histogram is below zero and red, treat the market as bearish and focus only on bearish momentum signals. If the histogram is above zero and green, treat the market as bullish and focus only on bullish momentum signals. That simple filter helps keep you aligned with the dominant pressure shown by the oscillator. Now I'm going to teach you a structured way to trade potential reversals using the zero-line crossover, but with layered confirmation so you're not jumping into every random flip. The key improvement is this: only treat a zero-line crossover seriously when it's supported by divergence first. Divergence is a concept where price and the oscillator disagree. It often warns that momentum is changing before price fully turns. When it shows up before crossover, it can increase the probability that the crossover is pointing to a real shift instead of a temporary pullback. Let's walk through a bearish reversal setup. Bearish reversal setup. Step 1. Find divergence while the histogram is above zero. Price makes a similar high or a higher high, but the histogram makes a lower high. That suggests bullish momentum is not as strong as it used to be, even though price is still pushing upward. Step 2. Wait for the zero-line crossover. After the divergence, when the histogram drops below zero and turns red, it signals that momentum has shifted negative. At this point, many traders make a mistake. They enter immediately on the crossover. Instead, we reduce risk by waiting for a pullback and then using the signal line to time the entry. This helps avoid entering on the exact pivot where price can still whip back the other way. Step 3. Wait for the signal line to confirm direction. After the histogram goes below zero, you want to see the signal line move below zero as well, showing the negative momentum isn't just a one-candle event. Step 4. Identify the pullback. When the histogram rises and crosses above the signal line, that often aligns with a pullback or a temporary relief move inside the new bearish move. Step 5. Trigger the entry after the pullback ends. When the histogram closes back below the signal line, you get a bearish momentum signal again. That's your pullback ended clue. And it's often a cleaner place to enter than the first zero-line cross. If the reversal is real, price should fail to break back above the prior swing high and should start printing lower levels as bearish momentum reasserts itself. Now let's flip it and do the bullish reversal setup. Bullish reversal setup. Step 1. Find divergence while the histogram is below zero. Price prints a lower low, but the histogram prints a higher low. That tells you bearish momentum is weakening even though price still dipped lower. Step 2. Wait for the zero-line crossover. When the histogram moves above zero and turns green, it signals momentum has flipped positive. Again, we don't rush the entry right there. Step 3. Let the signal line confirm. After the histogram moves above zero, you want to see the signal line also push above zero to confirm the shift has followed through. Step 4. Identify the pullback. When the histogram dips below the signal line, that often matches the pullback phase, where price temporarily retraces. If the reversal is legitimate, the pullback should fail to break the prior swing low, and price should start forming higher pushes as bullish momentum takes control. Now an important reminder: even with multiple layers of confirmation, no indicator or strategy will eliminate false signals completely. Markets can chop, news can hit, and conditions can shift, so you still need risk control on every trade. The goal here is not to find a magical indicator. The goal is to use the oscillator to read trend bias, track momentum shifts, and then only act when the signals line up in a structured way.